Welcome back to the show. I'm Ozbourne Foreman, and this week we are discussing big news around my biggest holding in my portfolio, Redrow. What I think of the housing market. Will we see a crash in the short to medium term? And also this week I have been selling out of different companies and bought new positions, so make sure to stay tuned right to the end to find out who. However, I'm currently making 4 videos a week, working 4 days a week, and going into London regularly for screenings, which I can't talk about yet, but this means that it's very, very difficult for me to keep up with this and have spare time for myself. Whilst I love what I do, it will eventually burn me out, and I've got to look for my health first. So I'm changing the schedule. Instead of 4 videos a week to 3 videos a week. I hope this is okay with you all, and I'll be uploading Tuesdays and Thursdays at 4 PM and Sundays at 9 AM. Thank you. As usual, I will not mention this information anymore on the channel, and it will all be on my Twitter. So make sure you drop a follow. It's in the link down below, or at Ozbourne Foreman on Twitter. And that's where I'll be able to keep you updated the best. So this week, a few of my companies have decided to pause, if not completely suspend, the idea of advertising on various social media sites. And I think this is a very intelligent move on their basis. And this might be due to the idea that these social media sites are doing a lot of fact checking on political statements. And I know that I believe this was the case with Twitter and Trump's management team, and they put a fact check underneath something they'd said, which I think is great for the community, but I think they are really messing with things they shouldn't touch. Like, I'm in no way political to any side, any position, any party, but I do feel that this is something they shouldn't do as a company. And that's why I'm not going to invest in these social media stocks, especially if they try to take that much power. With that in mind, the kind of companies that would be advertising on social media in my portfolio would be Diageo, not Diageo, I know I'm getting there slowly, Unilever, Aviva. These are all 3 very mature and grown companies. Advertising on social media isn't that lucrative for them. There's also the Stop Hate for Profit campaign, which is going to give them a lot of negativity if they continue to advertise on various social media platforms. And I think at a company of this size, rather than going for high risk, high reward, since they're so mature and large, they would rather not risk it all. So they would want lower risk but also growth potential. And since they can generate a majority of their sales elsewhere, it means that it's actually not very worth it for them to advertise on social media. And then they can use this spare money to either reinvest back into the business or save up their cash position due to the pandemic. WH Smith's has also announced that they are making redundancies. And whilst this doesn't impact the low-level employees, such as those like store clerks, but it does impact those in head office. Whilst this isn't good for the economy, this may be a wise move for WH Smith's or SMWH, and this allows them to reduce their overall operating costs by reducing the amount of employees, and it's very likely that we're going to see them probably remove their offices or downsize, as you don't really need an office that size anymore. Ideally, in the future, they would look to sell out of their high street positions and focus completely on travel centres and build up from there. However, what I do think for the economy is that the amount of people getting unemployed, and SMWH aren't the only ones contributing to this. A lot of companies are making redundancies or firing staff. A redundancy is the idea that they're in negotiations with their staff on the idea that they will pay them for them to leave the company. And a lot of companies are doing this, and this is going to lead to high unemployment. But what we're seeing currently is in a lot of these businesses that the higher skilled workers are being let go. And in that regard, I think there's going to be high unemployment. And in this perspective, there's going to be less demand for higher skilled workers in the short to medium term. And this is purely because there's going to be so many of them available, because there's so many redundancies, specifically in head offices, which is where they do a majority of their business operations, that it's going to lead to them struggling to find high role jobs. I mean, obviously they could probably work in a supermarket chain, a pub chain, a very low entry level place like a factory or something. But for these higher skilled workers, it's probably not worth their time. And they would typically be those like higher spending consumers. So I am concerned on the outlook for the economy on that behalf. WH Smith has managed to climb a few percentage points this week, and I've expanded upon my position with the company. On a more positive note, Unilever have partnered with Alibaba. Well, this can be seen as positive or negative. It depends on really how you look at it. I see this as a positive. Unilever have partnered with Alibaba and their Alibaba's cloud, which is their artificial intelligence. So what they are doing in this partnership is Unilever uses this AI on their digital marketing. This AI will learn from the kinds of what the consumers want and buy and when they buy, and that's the data they get from it. But Unilever get the exposure because Alibaba are going to be promoting their products to China, which is probably one of the best places to grow. And so it's very mutually beneficial for both of these companies. There were concerns in the past about Huawei, which is also another Chinese company, which had even been copying, or I'm going to quotation this because I don't know for sure, but stealing technology from other firms so that they could benefit faster and grow. So if you're worried about the expansion of Chinese companies doing this, then this maybe isn't a good thing for you. However, for the sake of Unilever, in the short to medium term and certainly the long term, we could see good, strong growth from it as they have access to this Chinese market and a lot more presence. As Alibaba is a very similar company to what I would say is Amazon. However, it is just primarily located in China. With the exposure of that, if Alibaba became more globally diverse, which I think it is, but it's not as well known of, it gives them an opportunity, and it gives Unilever such an opportunity in China. I currently only have about 6 shares, which is around £250 of equity. I do plan on adding to this position, but once the volatility has lessened and the market starts to steadily increase, as at the moment I'm looking for high risk, high reward stocks, and a defensive stock isn't quite what I need. However, the biggest news this week is about Redrow, my biggest holding. And a lot of you viewers have actually tried contacting me about this, and I've responded to as many as possible as I've seen, either down in the YouTube comments down below or on my Twitter. And you'd all ask me what my opinions were on Redrow and the latest news around them. And at first I was very negative, but I'd read further into the article and it actually proves very bullish for me. And I know at this point I'm probably Redrow's biggest bull or biggest fool. Who knows? But following the news that they had released on Tuesday, the stock dropped by 10%. So I was up 5% to now down 5%, which it's a bit overreactive, but that's a high volatility stock, so that's fine. On Tuesday, they announced that they were retreating from London. And if you'd have just read that headline, you probably would have thought, oh no, this isn't good, I'm going to have to sell my stocks. However, in reality, when you look at this news, why would you sell this company? Do you anticipate a housing market crash? In the upcoming years, I anticipate that the housing market will become less resilient. There has been various real estate agents which have said that they believe that the housing market is really resilient right now and is really showing signs of strength. And whilst there could be some truth to this, and so far it's holding up well, the housing market typically follows the economy and the stock market at a delay. And so you normally see the true impacts of it 6 months to a year later. And these real estate agents, they make more money when the housing market is booming, right? When more people are trying to buy houses, the real estate agents earn a commission. And with this commission, it makes up a bulk of their salary. So currently, I think there is a bias towards that because obviously they want people to buy houses so that they can earn money for themselves. And of course, there's nothing wrong with that. With that in mind, if you're a real estate agent watching this and you would like to hire a trainee real estate agent, please leave me an email or contact me on Twitter. Thank you. Yes, I know, but I've got to shoot my shot, hey? I personally don't think that the housing market will crash across the whole of the UK. However, I do anticipate it to happen in London. And this may sound ridiculous. And why do I think so? Well, since the start of the pandemic, people have actually been enjoying the notion of working from home. And with the working from home trend, people are looking to move out of London into lands with more space, such as that of a green belt. It's similar areas where I live currently, to be honest, and these towns already have very high housing prices. And I see this demand increasing. People are going to move further out of London so they can get a house, more land, more space, because they can simply work from home. And so with that, I see less of a demand for the properties in London. And with that reduced demand, landlords are going to have to reduce the prices or the rents for the tenants. And so as that drops, people are going to be moving outwards. Offices are also in this because I think a lot of businesses will be looking to reduce their office capacity and move people to home as it's easier for the companies and it's been proven to work during the start of the pandemic. In the future, I do think this will even out because as this demand drops in London, the prices will drop. And therefore, eventually, at some point, those prices are going to be fair to someone and then people are going to start moving back in, increasing the demand. a very simplified version of economic cycles. And this is what I see happening with the housing market, particularly in London. I think that whilst the houses around everywhere else will remain stagnant, maybe resist the crash, they'll probably stay very like inflation based and inflation linked and just stay there. But over the next medium to long term, they will increase faster than that of London. And I think, to be fair, London had it quite easy. I know I'm not qualified to talk about this subject, but everyone who had invested in real estate in London that had a lot of capital had found it very easy due to market appreciation and the rents they could charge. So it only makes sense that it evens out slightly, right? As always, I'd love to hear your opinion on this in the comments down below. But I do think this is quite bad for landlords and also REITs, real estate income trusts. Landlords, especially if they were over leveraged, meaning they'd taken on a lot of debt, could see themselves financially struggling and having to lose a lot of properties. However, the bigger landlords out there probably aren't going to struggle. And this is a similar state with REITs. I think a lot of office REITs are going to struggle. There's going to be a lower demand for offices, and therefore they may need to radically change their strategy in order to continue operating as a business. And it ultimately seems like the rich will be getting richer and the poor will be getting poorer, as a lot of the smaller REITs, smaller landlords will likely be going out of business. And unfortunately, c'est la vie. That's life. There's not much you can really do about it, and there's really not much you can do about the change in economic cycles. And therefore, the economy is likely to, in my opinion, achieve this. And that's why I'm actually very bullish on the idea that Redrow are moving out of London. I think London will see a decreased demand, as I've mentioned. They're moving out of London, especially if they target these properties with a calculated approach. They could see perhaps, right, okay, surrounding London, we've got Hertfordshire, perhaps Essex. These housing prices, keep them away from the coastlines, have them on a higher than sea level. You could see property appreciation across this area of land. You could also look for places with greater amounts of space. The more acres you have, the more valuable it is. But also don't forget that 25% of Redrow's revenues are actually from Help to Buy scheme users. So these houses are also still in demand. So you can also build houses for those looking for more cheaper houses, more standard houses that they can get onto the property ladder with. So that also needs to be factored in. And in fact, if you'd have only read the headline to this article, you likely would have sold, right? But in reality, if you'd have read further, you would have seen that Redrow, along with one of my other companies which had done this 2 weeks ago, Games Workshop, are actually no longer using the furlough program and paying it back. They are in such a strong financial position that they can easily afford to do this. And moving out of London only makes competition, which was already very fierce in London, a lot simpler. With this news, I initially bought around 25 shares. However, on Friday, I actually bought 75 more shares, which brings my total position up to an equity of around £2,150 or 500 shares. I'm likely not going to buy much more than this, as it's already such a big position in my portfolio, but it doesn't stop me from being extremely bullish on it. Perhaps in the future I will buy more, but it did come at a cost. I did sell a lot of my legal and general position, and I only have 100 shares left of that. Right now, 60% of you watching this video are watching it without being subscribed. And if you're interested in continuing to see my portfolio updates updated weekly and my monthly stock picks, then please consider subscribing. Thank you. And so I've changed a lot of companies in my portfolio since the last update. And in fact, I wanted to restructure things because initially when I'd started this portfolio in April, I looked for the best sort of company in each sector and thought, right, that's fine, I'm happy with them. However, when I look at it again, I've now found better companies I think will perform better in the long term. Those ones with better dividend growth, better capital appreciation, better fundamentals, better analysis for the future. And so this is what I've gone for. And so some of these companies like Rio Tinto, which performed really well and gave me something like a return of 16%, which is a diversified metals miner based in Australia. Whilst this is a great company, I was more or less looking for a hedge. I want a company that's a gold miner, so that when gold rises, so does the company. And that in a way gives me exposure to gold and therefore offers a hedge in times of uncertainty. And Rio, I think, are going to have some issues, as when they are mining in Australia, they are going through ancient burial grounds. And I think eventually that's going to be halted. But that applies to a lot of miners across the world. But I think Australia, amongst the other first world countries, will see this first. And with the way we're looking with the planet, we're trying to make trying to be as healthy as possible to the planet. We want to reduce our carbon emissions. We want to save the planet. We don't want to chop down as many trees, so it only seems reasonable. So with that in mind, I've gone for a much smaller company called Highland Gold Mining, which is a penny stock based in Russia, which would sound ridiculously stupid. I'm aware. I understand that it probably is extremely risky, but this is what I want. This is part speculation tied to gold. It has a slightly less dividend yield than that of Rio Tinto. I'm not so bothered on that. It's just the exposure I have there. So I sold out of Rio Tinto, which was around 12 shares at around 560 odd pounds, and bought into Highland Gold Mining. And I know it sounds completely ridiculous that I've done this at such a high risk. However, you also need to understand that I'm at a very young age. And so even if I lose such a high proportion of my overall net worth at this age, at least in the future, I can learn from this mistake and not do it with a much greater sum of money. Tesco, or the tractor supply company, and honestly, it's probably the last time I'm going to make that joke, so please consider clicking the like button, because believe me or not, I was sick of that terrible joke too. Tesco was actually a controversial stock I spoke about on this channel. However, I was kind of blinded by bias. A lot of you viewers had reached out to me and commented down below, suggesting that this isn't so good. We had a comment saying that Warren Buffett had sold out of it, which I wasn't initially aware of a few years ago due to the fact that they were cooking the books. And in this terms, it means doing something dodgy with the finances and therefore possibly taking money that they shouldn't have. Very similar to that of Wirecard, I believe, in Germany. So I'd like to thank Concerned Voter, who had commented down below and warned me of this and consistently questioned my idea of Tesco. Recently, last week, whilst I was slightly bullish on it at the time, they had decided not to compete with or compare themselves to that of Ocado, which only takes up a 1.6% market share, but this is a tech-only online retailer. They really should not be ignoring this, as they are in the same niche. And in fact, this is the mistakes that Tesco's have made before. They ignored Aldi and Lidl, which are clawing market share from them. They're just discounter stores. No one cares for them. Brand loyalty. And now they've realised this isn't the case. And I think it's too little too late. They're far too hubristic. Actually subconsciously realised that I wasn't that confident in this stock. And you could have seen that. If you'd looked at the last portfolio update, you could have seen the fact that I only had small amounts of equity in these positions. And whilst I was quite happy with them, subconsciously, I wasn't willing to invest more and more money. It doesn't make them necessarily bad companies, but I just wasn't that bullish on the future of them. Whereas Redrow, I've invested such a proportion in because I'm so confident in the future. But I think this will be repeated with Tesco and therefore lead to their downfall. So what I did is I sold out of my position with Tesco, which was around 29 shares, about £60, reinvested that straight back into WH Smith's. However, don't worry, I know I've just moved from that to consumer discretionary. I still have Unilever and Diageo, which are my consumer staples. I'm not going to give this stock too much time, but I did hold GSK. I really despised the UK pharmaceuticals. Some of the smaller ones I did like, however, they weren't great dividend payers. GSK, AZN, which are the two biggest in the FTSE 100, hadn't grown their dividend for 5-6 years. And that's probably because they thought they could get away with it because they're such big companies. Maybe there's other reasons behind this, but I don't like that. That does not fit my fundamentals. Whilst AstraZeneca has seen insane growth in the last 5 years, I don't think it can sustain this. And GSK has just done its thing. I'm not happy with the performance of that either. So what I've done is I had one share in GSK, sold it, and I've reinvested it in Dechra Pharmaceuticals, or DPH. And in fact, I've done a video on my channel about this. If you'd like to click the card at the top right of the video, I will go into a more fundamental analysis of this stock. However, put basically, is they are a pharmaceutical company that develops and sells medicinal products to veterinarians. So this is more for pets. And I think in the UK, since healthcare is pretty much free, it seems understandable why they would be investing, or why people would be spending more money on their pets than they would be their own healthcare, as it's NHS related. However, in the future, this could change, and I could be completely wrong, but I'm more bullish on this. Plus, their dividend history is amazing. I also sold out of one of the stocks I've mentioned the most on this channel, and I know spoken about Sage in probably double digit now of videos, which is a lot. And it is still a great company to own, but they haven't really done anything. Yes, they've got excellent dividend history and excellent dividend growth, but their share price is just stagnant. It would drop to £6.40. It would go up during the course of the week, return to £6.80, and it would just repeat this. I'm not a trader. I don't gain anything from this, and their dividend yield was 2.5%. And if they're not going to provide any capital growth, I understand this is a time of uncertainty, and they did hold their value very well, I will give them that. So perhaps it's a more defensive stock, but in the technology sector, I don't want defensive. I want aggressive. I want to be able to see great capital appreciation with a smaller amount of money that I put into it, which is quite greedy. And so what I'd done is I'd sold out of Sage and invested into Halma, which is still fairly defensive, given it is they're a technology company that invests in safety. So they will be buying other businesses around these safety aspects. There are other regions to it, but they also do like certain safety technology solutions. So they are defensive, and it's going to be demanded for each and all over across the year. And same for Sage, as they were accounting software where business payroll is important. But I just feel that Halma can effectively use capital more efficiently, and all I lose out on is about 0.5% of dividend growth from the last 10 years, which I think is acceptable, seeing as Halma has outperformed that of Sage by about 160% in capital appreciation. And so I sold out of Sage, it was about 20 odd shares, or totaling £160, reinvested that into Halma. Whilst it has a lower yield, I think it can provide much more capital appreciation in the future. And it's more diversified, really. That's what I really wanted in that technology spot. My portfolio is up 1.5% compared to that FTSE 100 of around 8%, and I think the FTSE 250 of 11%. However, this is my spreadsheet. My spreadsheet doesn't track cost basis, and it doesn't track the fact that I've sold out of LGN, sold out of Rio, and I've taken profits from that. Reality, I think it is higher than that, and the only way I'll really know is simply Wall Street. However, they update it at ridiculous times to do it in reviews such as quarters or years. With this in mind, I'm going to be depositing each and every week and buying WH Smith's, Ashted Group, Games Workshop. Once the volatility has calmed down, I will then look towards the other positions in my portfolio, such as Unilever, Diageo, and perhaps Highland Gold Mining. This is the Ozbourne Foreman Show. Thank you for watching, and I'll see you Tuesday at 4 PM for my FTSE 100 growth stock to buy. Have a good night.